Good afternoon and welcome all. My name is Sue Lemon, CEO of CFA Society Toronto, and I would like to welcome everyone to today's Economic Progress Report presented by Banque du Canada Governor Tiff Macklem. CFA Society Toronto and the Banque of Canada would like to acknowledge that we are speaking from the land of First Nations, Inuit, and Métis people. Myself from the traditional territory of many nations, including the Wendat, the Anishinaabe, the Haudenosaunee, the Métis, and the Mississaugas of the Credit. And Governor Macklin from the traditional unceded territory of the Algonquin Anishinaabe people. We pay our respect to Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. A few housekeeping notes. If you have any questions at any point in time during this session, please add them to the Q&A section. You should see a question box at the right side of the screen. Please write your name, email, and question in there, and then click Submit. It is now my pleasure to welcome our guest speaker, Tiff Macklem, Governor of the Banque of Canada. Tiff Macklem was appointed Governor of the Banque of Canada in June 2020 for a 7-year term. Mr. Macklem first joined the Banque of Canada in 1984 and held various senior positions, including Chief of Research and Advisor to the Governor. He was appointed a Deputy Governor in 2004 and Senior Deputy Governor in 2010. During the global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. From 2014 until his appointment as Governor, Mr. Macklem was the Dean of the Rotman School of Management at the University of Toronto. Governor Macklem, we look forward to hearing your comments today.
Well, thank you for that introduction, Sue, and it is a pleasure to be with you today to provide an economic update. And I also want to discuss both our monetary policy decision yesterday and what Canadians can expect from us going forward. Before I begin, I do want to acknowledge the shocking developments that have taken place in the past week in Ukraine. The senseless loss of human life and the devastating impact of this unprovoked Russian invasion on the Ukraine people are beyond comprehension. I know this is an extremely anxious time for the many Canadians who have family and friends in Ukraine, and my thoughts are with you. The invasion is also a major new source of uncertainty and volatility in the global economy. The situation is fluid, and we are following events closely and will be assessing the ongoing economic impacts. These events come just as we approach the 2-year mark of the COVID-19 pandemic. The economic recovery from the pandemic has been impressive. While uncertainty about the evolution of the virus remains, the agility and resilience of Canadian households and businesses through the past 2 years of immense challenge cannot be overstated. And after providing extraordinary stimulus to support the economy through this tremendous shock, we are now clearly on a path to normalizing monetary policy. That's what I'd like to discuss with you today. In January, when the Banque of Canada released its quarterly monetary policy report, we told Canadians that emergency monetary policy measures needed to support the economy through the pandemic were no longer required. We ended our exceptional forward guidance and told Canadians they should expect a rising path for interest rates. Yesterday, Governing Council took the decision to raise the policy rate by 25 basis points to 0.5%. This is the first step on that path. We also said that we will be considering when to end the reinvestment phase of our large-scale asset purchases and allow the bank's holdings of Government of Canada bonds to begin to decline. This process is known as quantitative tightening, or QT. The timing and pace of further increases in the policy rate and the start of QT will be guided by the bank's ongoing assessment of the economy and its commitment to achieving the 2% inflation target. Hier, le conseil de direction a augmenté le taux directeur de 25 points de base. Le taux est donc passé à 0,5%. C'est un premier pas vers une remontée des taux d'intérêt. Le Conseil va aussi évaluer quand il mettra mettra fin à la phase de réinvestissement et laissera notre portefeuille d'obligations du gouvernement du Canada commencer à diminuer. Ce processus s'appelle le resserrement quantitatif. Le moment et le rythme des hausses subséquentes de taux directeur et le début du resserrement quantitatif seront guidés par l'évaluation continue que fait la Banque de l'économie et par son engagement à atteindre la cible d'inflation de 2%. Today, I will provide an update on economic developments with a focus on inflation and the forces behind it. I'm also going to review the role of monetary policy in bringing inflation back to target. And finally, I want to look ahead to the next phase of our balance sheet management and the mechanics of QT. Like so many things that have happened during the pandemic, this will be new territory for Canadians. And I want to ensure that the process is clear and transparent ahead of time so that everyone understands what comes next. The Canadian economy is robust. GDP growth in the fourth quarter was very strong at 6.7%. This has reinforced our view that economic slack in the economy has been absorbed. And growth in the first quarter looks more solid than previously projected. As expected, inflation remained high. Inflation control is our number one job at the bank, so I want to explain what is driving these price increases and what Canadians can expect looking ahead. Since last spring, CPI inflation surged well above our target range of 1% to 3%. In January, CPI inflation was 5.1%. The Russian invasion of Ukraine is driving up international prices for oil, wheat, and other commodities. This will put further upward pressure on inflation in Canada and around the world. Setting aside the crisis in Ukraine, the surge in inflation we have seen since last spring largely reflects pandemic-related shifts in global supply and demand. But this rise in inflation has been larger than we expected 6 months ago, and price increases have broadened. So I want to take a closer look at the forces at play. One indication of the unusual forces at play is the large gap that has opened up between different measures of core inflation. All three of our core measures have increased in recent months. CPI common, which is more related to inflation in services and less influenced by global supply disruptions, was only 2.3% in January. In contrast, CPI median and CPI trim, which have been more influenced by the prices of globally traded goods, were 3.3% and 4% respectively. The inflation story in Canada has three key elements. The first is the global shift towards goods and away from services during the pandemic, combined with pandemic-related disruptions to the production and delivery of goods. The second is a broadening of price increases to everyday items like groceries and gasoline. This is making it more difficult for consumers to avoid paying higher prices. And the third is the strength of the Canadian recovery and the overall balance between demand and supply in the economy. These elements are all interacting, but I'd like to take them each in turn. In the 2 decades before the pandemic, price inflation for goods was generally low, indeed on average well below our 2% target for overall inflation. This reflects a combination of factors. Innovation drove prices of many goods lower, particularly for computers and other goods with embedded technology. Increasingly specialized and efficient global supply chains, together with reductions in international shipping costs, also put downward pressure on goods prices in Canada and around the world. In contrast, the prices of many in-person services that are necessarily more local and more labor-intensive saw larger price increases on average. Between 2015 and 2019, goods inflation averaged 1%, while services inflation, excluding shelter, averaged 2.4%. The pandemic has dramatically shifted the relative pressures on the prices of goods and services. Stuck at home, Canadians and indeed consumers in most countries have spent less on services such as gym memberships or travel. As a result, many services prices have been rising more slowly than usual. In January, the rate of increase in prices of services excluding shelter was 1.6% in Canada. But unable to buy the services they wanted, consumers shifted to goods. Canadians have bought exercise bikes, office furniture, electronics to help cope with living, working, and playing at home. This has put upward pressure on goods prices. Supply problems have substantially exacerbated the situation. Just as consumers were spending more on goods, the supply of these goods was squeezed as health concerns hit overseas factories and ports became congested. Pandemic-related restrictions and precautions around the world have limited production and slowed the delivery of goods. This double whammy of higher demand and impaired supply has resulted in sharply higher prices for many goods. In January, goods price inflation in Canada was 7.2%. The last time it was that high was January 1983, when overall inflation was 8.2%. As the pandemic recedes, we can expect consumers to shift back to spending more on services, and this should take some pressure off the demand for goods. We can also expect supply chains to normalize. But predicting how long this will take is difficult. And the war in Ukraine is compounding this difficulty, as it could also disrupt global supply chains. As you might expect, we have been working hard to better understand and track supply chain disruptions. Our near-term outlook for inflation depends importantly on how they evolve. We're closely tracking new and different sources of data that tell us more about shortages, logistics, and shipping costs. What is clear is that supply chains remain highly disrupted. But the data also show us some tentative signs of improvement. Manufacturers in Canada are starting to receive inputs a little quicker, and global transportation bottlenecks have eased slightly. Canadian motor vehicle production has also begun to recover from slowdowns caused by shortages of semiconductors. But global shortages of key commodities remain a challenge. Overall, we expect global demand and supply of goods to gradually come into better balance through 2022. The second element of the inflation story in Canada has been a broadening of inflation beyond the items that are directly affected by supply chain disruptions. The bounce back in energy prices from pandemic lows has been contributing to inflation for more than a year now. But a combination of strong demand growth, limited investment, and geopolitical risks has now pushed oil prices well above pre-pandemic levels. This is boosting CPI inflation directly and is adding to already high transportation costs. These higher costs are affecting an increasingly broad spectrum of goods. In addition, extreme weather has reduced harvests in Canada and in other growing regions, and this is pushing up food prices. And in Canada, strong demand for housing combined with higher costs for building materials is pushing up new house prices, increasing the shelter component of CPI inflation. One way to measure this broadening of price pressures is to look at how many CPI components are seeing high rates of inflation. As of January, across 165 CPI components, almost 2/3 were growing above 3%. This includes gas and groceries and necessities, whose prices Canadians see daily. Grocery prices are up 6.5% from last year, and everyday foods that are hard to substitute, such as beef, chicken, and cereal, are all getting more expensive. This broadening in price pressures is a big concern. It is making it more difficult for Canadians to avoid inflation, no matter how patient or prudent they are as shoppers. This is affecting the most vulnerable Canadians the most. It also increases the risk that households and businesses will begin to expect large price increases to continue, and this becomes embedded in long-term inflation expectations. The lesson from history is that if inflation expectations become unmoored, it becomes much more costly to get inflation back to target. So far, long-term inflation expectations have remained well anchored, and Canadians can expect us to use our tools with determination to keep them that way. This brings me to the third element of the inflation story, the overall balance between demand and supply in the economy. As we indicated in January, a wide range of measures suggest economic slack has now been absorbed. The spread of the Omicron variant was a tough way to start the year, with 200,000 jobs lost in January, mostly among the same service sector workers who have borne the brunt of pandemic layoffs all along. But other data have generally been robust, and with public health restrictions now easing, we expect strong growth to resume. With the economy just back to its potential output, the elevated inflation we are experiencing today is not the result of too much demand in the economy. But if we look ahead, with slack absorbed and considerable momentum in demand, we need higher interest rates to dampen spending growth so that demand does not run significantly ahead of supply. In practice, the three elements that are driving inflation are interacting to push inflation up. But raising the policy rate will not fix supply chain disruptions, nor will it lower oil prices. What monetary policy can do is make borrowing more expensive, which slows domestic demand. For households and businesses that are already facing higher inflation, a higher cost of borrowing could be doubly painful. But tighter monetary policy is necessary to lower the parts of inflation that are driven by domestic demand. Tightening monetary policy is also needed to keep inflation expectations well anchored and to limit the broadening of inflationary pressures so that inflation falls back as supply disruptions ease. These three elements of the inflation story all weighed on our monetary policy decision announced yesterday. We expect inflation to come down in the second half of this year as the pandemic eases. But with inflation substantially above our target, we are more concerned about upside risk to our inflation outlook. The broadening of price increases is making inflation harder to avoid and raises the risk that inflation expectations could drift higher. And with slack now absorbed, the momentum in demand means that monetary policy has a clear role to play in getting inflation back to our target. Against this backdrop, yesterday the Governing Council took the first step on a path to higher interest rates, raising our policy rate by 25 basis points to 0.5%. This takes our policy rate off its floor for the first time since March of 2020, 2 years ago. We will also be considering when to end the reinvestment phase of our large-scale asset purchases and allow our holdings of Government of Canada bonds to begin to shrink. The impact of raising our policy rate will be higher interest rates for Canadian households and businesses, including mortgage and prime lending rates, and also rates for savings products. The economy is now in a place where moving to a more normal setting for interest rates is appropriate. The economy can handle it. We know this will be a significant adjustment, and we fully intend to tighten policy in a deliberate and careful way, being mindful of the impacts and monitoring the effects closely. The bank is committed to returning inflation to the 2% target and keeping inflation expectations well anchored. L'augmentation du taux directeur va faire monter les taux d'affaires aux entreprises et aux ménages canadiennes, comme les taux hypothécaires et les taux préférentiels des prêts, et aussi les taux des produits d'épargne. Mais le contexte actuel, il est approprié d'amorcer un retour à des taux d'intérêt plus normaux. L'économie est capable de le prendre. On sait que ce sera un ajustement important. Et on a la ferme intention de resserrer les politiques monétaires de manière réfléchie et prudente en suivant les effets de près. La Banque s'est engagée à ramener l'inflation à la cible de 2% et à garder les attentes bien ancrées. I'd like to now turn to the second part of my remarks today. With the decision yesterday to raise the policy rate, ending reinvestment and moving to QT would be a natural next step. Before I explain how QT would work, let me review how we got here. When the pandemic hit in the spring of 2020, we undertook large-scale purchases of Government of Canada bonds, first to help restore market functioning, and then to bolster our monetary policy stimulus. This program, known as quantitative easing, or QE, helped lower borrowing costs for households and businesses and governments by putting downward pressure on long-term interest rates. When QE began, we were buying at least $5 billion of Government of Canada bonds a week. Combined with exceptional forward guidance, QE lowered the interest rates on longer-term bonds. But as the economic outlook improved, less QE stimulus was needed. In October 2020, we began reducing the pace of purchases, and in October 2021, we ended QE and entered the reinvestment phase. For the past 4 months, we've kept the size of our holdings of Government of Canada bonds stable, purchasing only enough bonds to replace those that are maturing. When we initiate quantitative tightening, or QT, we will stop purchasing Government of Canada bonds. From that point forward, maturing government bonds will not be replaced when they roll off the balance sheet. The bank's holdings and the maturity schedule of those bonds are published on our website, so the timing and pace of QT will be fully transparent. We do not intend to actively sell bonds. Relative to the balance sheets of most other central banks that have undertaken QE programs, ours had a shorter average term to maturity. Roughly 40% of our bond holdings mature within the next 2 years. This suggests that other things being equal, our balance sheet would shrink relatively quickly. QT would complement increases in the policy rate, putting upward pressure on interest rates at maturities where households and businesses typically borrow. But let me underline that our primary tool is the policy interest rate. Adjustments to the pace and timing of the removal of monetary stimulus will focus on our policy rate. This reflects several considerations. Changing the policy rate to speed or slow the economy has a long history, and interest rate changes are easier to calibrate and communicate. Our policy rate is a nimble tool, and we've used it to deliver low, stable, and predictable inflation since the Bank of Canada began inflation targeting in 1991. Changing our policy rate will therefore remain our most important monetary policy tool. And as we said in January, Canadians should expect a rising path for interest rates. Pour conclure, on vit une période inquiétante. L'attaque sur l'Ukraine par la Russie est très troublant. C'est une nouvelle source d'incertitude. Ça vient s'ajouter à l'incertitude qui persiste sur l'évolution de la pandémie, même à la fin de la vague Omicron. Les problèmes d'approvisionnement continuent aussi. Toutes ces questions ont été au centre des discussions qui ont mené à notre décision d'hier. On va devoir composer avec elles. Mais les capacités excédentaires se sont résorbées. L'économie est sur une solide lancée et l'inflation est trop élevée. Compte tenu de tous ces facteurs, la Banque a fait hier le premier pas pour normaliser la politique monétaire au Canada. Les Canadiennes et Canadiens peuvent être sûrs que la Banque va continuer à faire ce qu'il faut pour remplir son mandat. Let me conclude. These are anxious times. The Russian invasion of Ukraine is deeply troubling and has injected new uncertainty. This comes atop continued uncertainty about the evolution of COVID-19, even as the world makes its way out of the Omicron variant. Supply chain disruptions also continue, distorting the prices and availability of many goods. All of these issues featured prominently in our deliberations leading to yesterday's decision, and we're going to need to manage through them. But slack in the economy is absorbed. There's solid momentum, and inflation is too high. Putting all this together, yesterday the bank took the first step on a path to normalizing monetary policy in Canada. And moving forward, Canadians can be confident that we will continue to act to deliver on our mandate. Thank you. And I look forward to your questions.
Thank you very much, Governor. And we have a question that takes us back to the beginning of your speech and one that's on everyone's minds. How has the Russian invasion of Ukraine impacted the Bank of Canada's thinking on the economic outlook, and how do you plan to factor it in going forward?
The most direct impact, of course, is on the people of the Ukraine, and their suffering is incomprehensible. We are inspired by their courage. As I mentioned, this is a major new source of uncertainty in the global economy. This invasion has just now entered its second week. Events continue to unfold. It's not clear where this goes from here. We are certainly following events closely, and we will be assessing the impacts in Canada. In terms of assessing those impacts, our direct trade links with the Ukraine or with Russia are fairly minimal. So the impacts are more indirect, but there are a number of important channels. The first and most direct one is, as we've seen, this invasion has resulted in a sharp increase in commodity prices, particularly oil prices, and that will push inflation higher in Canada and around the world. Financial market volatility has increased substantially in recent days. You're seeing some flight to safety, flight into US dollars. You're seeing considerable volatility in equity markets, in bond markets. And the sanctions that have been imposed on the Russian economy are clearly having a very profound effect on Russia. I think we could probably also expect that there are going to be some further supply disruptions. As I outlined in my remarks, globally, there are already shipping bottlenecks. The supply system is impaired, and I think we can expect that this invasion will result in some new shipping disruptions and supply disruptions. And of course, look, it is going to weigh on confidence, and that too will have an effect on economic activity. As we move forward, we're going to have to factor these in to what their impact is on the Canadian economy. But as I underlined in my remarks, the Canadian economy is strong. We saw very strong growth through the second half of last year, and the momentum through the beginning of this year, even as we've dealt with Omicron, has been stronger than we expected. So there is solid strength in the Canadian economy, and that was reflected in yesterday's decision.
Thank you. The next question is, how is the bank viewing the labor market changes happening in Canada as a result of the pandemic?
Well, let me divide that up into three pieces. The first is the macro perspective. This pandemic had a massive effect on our labor market. At the outset of the pandemic, 3 million Canadians lost their jobs, and more than 3 million were working. More than another 3 million were working less than their 50% of their normal hours. Since then, we have seen a very impressive labor market recovery. Today, employment is above its pre-pandemic levels, and actually job vacancies are very high. Businesses are telling us they're having trouble finding all the workers they want, and you've seen wages have been moving up. The second dimension is the tremendously uneven impacts this recession has had on the labor market. Look, recessions always have very uneven effects on the labor market, but this one, because of the unique circumstances, particularly affected high contact service sectors. I imagine most of the people listening to my remarks were able to pivot pretty quickly and work from home. And while I'm sure it was very disruptive, my expectation is most of you have been working harder than ever. But large parts of the economy were deeply affected, and that particularly affected low-income workers. It particularly affected youth, young workers, women. And what we've seen with the recovery is that as the economy has recovered and as the schools have reopened, those very uneven effects have dramatically diminished. So youth employment is now back to pre-pandemic levels. Female employment is now back to pre-pandemic levels. Low-wage workers have recovered a long way. They're not quite back, but it's come a long way back. And what we we've been spending a lot of time looking at the labor market at a more granular level, because to understand what's going on in the labor market, you really need to look at these different sectors, because there has been so much unevenness. The final thing I will mention is looking more forward. What are the longer term implications of this pandemic for labor markets? And I imagine, many of your companies are considering or have already moved to some sort of hybrid work format. Some companies are allowing people to work entirely remotely. This is going to make the labor market more flexible. Hopefully it'll draw in some workers that perhaps didn't want to live somewhere and now can work remotely, or needed more flexible hours. This is going to help people find jobs that fit their skills better. It's going to help employers, businesses find draw new workers into the labor force, find new talent. And I think the other part of it is this pandemic has really accelerated digitalization. And I think this is going to put a premium on digital skills. I think workers need to make sure they've got those digital skills, and employers need to invest in their workers. And that combination of a more flexible workforce with the skills for the 21st century should grow our economy. It should draw more people in the labor force and make workers more productive, which means more scope for the economy to grow and higher wages for Canadians.
Good news. And now a housing question. With the increasing path for rates, do you expect any increase in defaults in the housing market? Do you expect a drop in home prices or a housing market crash, perhaps?
Housing market activity is very elevated. We've seen very strong demand for housing, and housing prices have been moving up at an unusual pace. What are we expecting? Yesterday we raised interest rates. We've signaled very clearly to Canadians that interest rates will be on a rising path. That's already reflected in say 5-year fixed mortgage rates, and if you have a variable rate mortgage, we've signaled. Well, it went up yesterday, and we've signaled you can expect it to go up some more. And one of the reasons why we're getting out ahead and signaling where things are going for Canadians is so that they can adjust. This is going to be an adjustment, but we need this. Our economy can handle this. And those higher rates, we do expect, will begin to moderate growth in the housing sector. That's a good thing. We can't sustain the kind of growth we're seeing in the housing sector. We need to moderate spending growth overall in the economy so it doesn't run ahead of the supply capacity of the Canadian economy, so we don't create a new source of domestic inflation in this economy.
And as a carry-on from that, rising interest rates have the potential to calm prices, house prices, as you just mentioned, but the higher costs can also hurt affordability for those that are hoping to purchase their first home. How do you balance the benefits and the harm of interest rate hikes on all mortgage holders, but particularly on the prospective home buyers?
Well, let me try to answer that in a few ways. First of all, you have to keep in mind that the Bank of Canada has to look at the whole economy. Our mandate is to control inflation, and we have one instrument really, which is interest rates, and we use that to influence spending to try to bring demand and supply in line to keep inflation, bring inflation back to our target. And if we don't do that, and inflation expectations move up, nothing in the economy is going to work better. So that is our job one. We're going to raise, as we raise rates, we are going to do it mindfully. We are going to be watching to see, as we move up that rising path for interest rates, at what point does it start to have the most traction? And we will be assessing the implications on the housing market, on consumption, and on the economy overall. And we'll be calibrating our response to reflect that. But I think what is clear right now is that we're still at very low interest rates. We've got an economy with solid momentum that has absorbed the slack, and we are going to need to move interest rates higher to get that balance.
Makes sense. Before the interest rate decision was announced yesterday, did Governing Council consider a 50 basis point rate hike as a possibility? And what were the considerations driving the decision to hike rates by 25 basis points rather than a higher amount?
We took an important decision yesterday. We've held our policy rate at its effective lower bound of 25 basis points for almost 2 years now. That was an important decision to raise it off the lower bound, and we also signaled to Canadians that they should continue to expect a rising path for interest rates. As we look forward, inflation is well above our target, and with inflation well above our target, we are more concerned about the upside risks to inflation than the downside risks. There's certainly considerable space to raise interest rates over the course of the year, and if we need to be, how quickly or how slowly we do that is really going to depend on the evolution of the economy and our outlook for inflation. And if we have to move more quickly, we are prepared to do that. So I'm not going to rule out a 50 basis point move in the future.
Thank you. Is the Bank of Canada satisfied that there are adequate measures in place to protect our financial system from cyber attacks?
You can never be complacent about cyber attacks, but I will say that the financial system has among the most advanced protection, and I can also tell you that the Office of the Superintendent of Financial Institutions, which oversees our financial system, is certainly alert to that, and that is one of the things they regularly assess as part of their supervision of our banking system. The Bank of Canada also chairs a coordinating group with public security and the government's cyber system, together with the financial system, to try to make sure everybody's working with the best available information and shares the best available technology and how to best protect us from this threat. Look, cyber risks are out there. We have to be very alert to them, and we have to continue to invest to stay ahead of the bad guys.
Yes. Back to inflation. Can you explain how much of the inflation growth is due to higher energy costs? And is there a sense as to the impact that higher oil prices, or what higher oil prices will have on GDP growth?
So so inflation is just over 5%. So if you break that down, about 2.5 percentage points, or about half of the 5%, reflects goods that are experiencing serious supply constraints. So about half of that 5% is goods where there are serious disruptions to supply. There's about an extra percentage point of inflation coming from energy. Now, in the last several weeks, energy prices, oil prices in particular, have moved up sharply. I looked at the screen before I came down. Oil prices were about $110. So relative to where we are now, that would probably, you could expect just the direct, so if a price of $110 were to be maintained, you could expect that would add about another further percentage point to inflation. There are also higher, other commodity prices have also gone up, food prices, for example. And if these higher energy prices are maintained, there could also be some higher transportation costs, so some more direct effects. So also say, particularly since the invasion, we've seen a lot more volatility in these prices. I'm not going to give you a new forecast, but what's pretty clear is that they are going to add further to inflation in the near term, and we can expect inflation to be higher in the near term as a result. With respect to your question on income, well, look, obviously, these higher prices are going to impact Canadians fairly quickly. They're going to see it fairly quickly at the gas pump. They may start to see it in the grocery store. And so, I mean, that's going to hit them right in the pocketbook. The other element, though, is that Canada actually is a big net exporter of many of these goods. We're a big net exporter of oil, wheat, potash, nickel, for example. When those prices are higher in global markets, that means our export, more income comes into our country. We get more for every unit that's exported. So that will tend to increase income. When you look at, though, the overall impact of this invasion, it's also going to have effects on confidence. It's going to it may disrupt supply chains. As I stressed earlier, we're just a week into this, and we'll be having to assess the full overall impact.
Thank you. In your speech, you touched on how unavoidable inflation has been impacting households. What is your outlook on wage growth? And do you think it will rise in line with inflation?
So wage growth through the pandemic was very low, and it has been coming back up to, and it's now back up to roughly pre-pandemic levels. And the key for, and what we're certainly, what we're hearing from employers is they're having trouble finding all the workers they want, vacancies are high, and their expectations are that wages will go up further. And the key to wages is that productivity growth and wages need to go up together. As long as productivity grows up with wages, the productivity growth pays for those higher wages. So they're not inflationary. And a few weeks ago, I spoke to the Canadian Chamber of Commerce, highlighting the importance of business investment, because when businesses invest, that gives workers better tools, that makes workers more productive, and that means that higher wages are not inflationary. The fourth quarter national accounts that were just published on Tuesday, there was some good news in there. Business investment was very strong in the fourth quarter, and in fact, there were some historical revisions suggesting that it was even stronger than we thought through parts of the pandemic. And when you look at our own surveys of businesses, what we hear is that investment intentions have never been stronger. So that is a very good sign that businesses are going to be investing. That's going to grow the capacity, and that can sustain higher wages. Where we would get worried is if wages started to run significantly above productivity growth. If that happens, they can start to become an independent source of inflationary pressures. We're not seeing that yet, but that is certainly something we're watching closely.
Thank you. And our last question. Much has been made of real estate's substantial contribution to GDP growth over the last decade or more. As that growth becomes more tepid, what sectors do you expect may pick up the slack?
Well, actually, what we've seen through this pandemic is that the key drivers of growth have been household consumption and housing. And we expect that they will both remain reasonably solid. We do expect some moderation in growth from housing, but we expect it to continue to grow. Immigration is coming back. People have jobs. Wages are going up, so incomes are good. So even with interest rates rising, we do expect to see solid demand for housing, but some moderation in the growth. You know, what do we expect to see? We expect to see some broadening of growth. And in fact, we saw that in the fourth quarter. And by broadening, I mean more business investment, more exports. They were both quite strong in the fourth quarter. And we would hope to see that is sustained. The U.S. economy, our biggest export market, is growing strongly. They've also got, they're also probably already slightly in excess demand. So, that means that they are going to be looking for our imports. That's going to create solid demand for our exports. And businesses are telling us they're hitting up capacity constraints. As I just mentioned, their investment intentions have never been stronger. So there's good reasons to believe we're going to see both stronger investment and stronger exports. And that will broaden the recovery and really is key to sustaining solid growth.
Thank you. Thank you so much, Governor, for sharing with us your views on how you're going to deploy all of the tools at your disposal in terms of rising rates and QT in such a thoughtful and transparent way that Canadians can follow and understand. And we know that you're taking into consideration everything that's affecting all of us personally as well as internationally. We take comfort in also knowing that the supply chain issues are starting to subside a little bit. Also that the Canadian economy is so strong as a result of all the proper stimulus that's taken place, and that Canadians will actually benefit from some higher prices as well. So it's nice to know that as well. We thank you and your team for your leadership and stewardship in such challenging times. We hope that everyone enjoyed the session today. Thank you again for joining us. And on behalf of CFA Society Toronto, we wish you a good rest of the day and evening. Goodbye for now.
Thank you for having me.